What is going on, guys? It is Dimitri Wallace here, the CEO and founder of Gold Mines. Today, we are starting on a whole new path towards education with trading gold. As you guys know, our last video that we had came out with was in 2016. It was a tick boom method, something that I personally use and believe was working for me. So I wanted to share that with you guys. And I've seen a lot of people have gotten a lot of great success from the tick boom. But today, I'm coming here to teach you guys something extremely new that I've discovered that's been working for me. So hopefully it'll work for you. And now, I want to share that with you guys. So before we get started, I would just like to just make a quick disclaimer here from the CTFC. Okay, so hypothetical performance results have many inherent limitations, some of which are described below. No representation is being made that any account will or is likely to achieve profits or losses similar to those shown. In fact, there are frequently sharp differences between hypothetical performance results and the actual results subsequently achieved by any particular trading program. One of the limitations of hypothetical performance results is that they are generally prepared with the benefit of hindsight. In addition, hypothetical trading does not involve in financial risk, and no hypothetical trading record can be completely account for the impact of financial risk in actual trading. For example, the ability to withstand losses or to adhere to a particular trading program in spite of trading losses are material points which can also adversely affect actual trading results. There are numerous other factors related to the markets in general or the implementation of any specific trading program which cannot be fully accounted for in the preparation of hypothetical performance results, and all of which can adversely affect actual trading results. So trading does require risk. Do not risk any money you can't afford to lose. That's for Forex, and that is for gold as well. Futures, commodities, indices, stocks, whatever it is that you may be trading. So trading foreign exchange on margin carries a high level of risk and may not be suitable for all investors. So the high degree of leverage can work against you as well as for you. So before deciding to invest in foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. So the possibility exists that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you can't afford to lose. So you should be aware of all the risk associated with Forex exchange trading and seek advice from an independent financial advisor if you have any doubts. I'm not a financial advisor. This is not financial advice in any way, shape, or form. It's just me sharing my strategy and what works for me. And you are more than welcome to use it. You don't have to, but this is just what works for me, so hopefully it works for you. So now that we went over those quick disclaimers, let's get started, guys. Okay. First off, okay, this is TradingView, okay? TradingView.com is the website that you're going to go on to look at the tickers, okay? And the tickers is basically the trading symbols. So we have XAU USD, we have XAU CAD versus the Canadian dollar versus the Japanese dollar. You can go here and type GBP JPY. That's the Great British Pound versus the Japanese dollar. You can go ahead and type USD JPY. That's US dollar versus Japanese yen. USD CAD. So you get the picture. This is the ticker, okay, that you can use to look at the pair that you want to look at. So we're going to look at gold. All right. I'm going to click that. We're going to click interactive chart. And then boom, we got the gold chart. All right. Let me just remove this. Make this clear for you guys. All right. So this is the site that you guys are going to be using for looking at your charts. All right. And also we have here, we have Investopedia. So Investopedia is also a great site that you guys can go to if you have any questions or you want to learn more about trading terminology. You can just go ahead and type it in here. So you can just type Forex or anything that you wanted here, and it will pop up, okay, and give you the definition. So let's say you want to type in something like spreads. Investopedia is a great site just for getting familiar with trading terminology and for educating yourself as well. Awesome site, one of my favorites. because I don't know obviously everything. So there may be questions where I may go to and I may research a word or something. It's like the encyclopedia, or you could say the Webster for investing. Okay. So then next we have investing.com, which is a really great site as well. You can go here and look at the latest news for cryptos, for gold, silver, whatever it is that you're interested in. They do amazing updates. They're very on top of their updates. So you'll see articles coming out every 2 to 3 hours. All right. Let's type in gold, and then you can see here. Okay. You go to news, and then boom. Okay. So these are all the articles on golds that you can look at. Awesome. All right. So these are just your resources that you want to go to. Just because gold also does require some fundamental analysis. It's not just 100% all technical. There is, certain news events and things that happen that could impact the price of gold. So what you want to do is you want to go to Forex Factory. Okay. Forex Factory tells you when there's a news event that's going to be extremely important. So you can see they have the euro here. It tells you the date and the time and what's related to it. Okay, so usually the red folders are high impact folders, and any other color folders are more like low impact. But you see the FOMC member, Quarrel Speaks, that would be important. USD, ISM non-manufacturing PMI, that would be important. All these red folders would be important. Okay, so if you ever want to see if something is going on, you just go ahead and you click the folder, and it shows you why traders should care and what's actually going on with it. All right. So that's one thing that you guys definitely want to do. You always want to check news before you get into any trade, because anything could happen. You can get into a really bad trade where something just kind of spikes against you. Something like this. See that? Yeah, you don't want to get into that. So you definitely want to check news and see what's going on before you enter a trade. All right. And if you're not used to trading news, I highly suggest that you stay away from it until you have a strategy down pat to go over news, which we will be going over strategies for news. So wonderful. All right. Now let's get to it. Okay. Now this is just, like I said, this is just a beginner's course for people who have not been the best at trading or want to get into trading. Okay, so I'm just going to go over candlesticks. All right, now these are called Japanese candlesticks. All right, Japanese candlesticks were used many years ago to measure the imports and exports of rice, believe it or not, as crazy as that sounds. So now they are used to tell you the price of gold, silver, any commodity indice, stock, or whatever it is that you're trading. Okay. Now there's more than just candles, Japanese candlesticks. There's bars. These are open, high, low, close bars. As you can see, they don't have any bodies like the regular candlesticks. Okay. These are hollow candlesticks. Okay. These are Heikin-Ashi candlesticks, so the open, high, low, close is also different because what Heikin-Ashi candlesticks do is they smooth out all of the noise. Okay, so you can see the open, high, low, close is very different as it would be on regular candlesticks. Okay, so just keep that in mind. Then you have the line chart, which is more of a directional based market. So it shows you, going up, going straight down. There's really no body or anything that can give you a clear indication of what's going on with price, what's psychologically happening with price. I like to use a line chart sometimes, but that's if just to confirm if the trend is going up or down. So I use a line chart. I'll switch to Heikin-Ashi and then switch to regular candlesticks, but we'll get into that after, okay? So this is the line chart. Then you have area, which I don't use, or I'm not really sure if anyone uses that. And then you have Renko bars, okay? I personally, myself, love Japanese candlesticks. This is the only thing that I used. It just gives me a better perspective of the market. You're definitely entitled to use whatever works for you. But this is what I use primarily, okay? And then I may switch to Heikin-Ashi or line to, find out the trend, where the true trend is going, okay? So let's get into it, okay? Now, every single one of these candlesticks, okay, have a different body size. Some are fat, some are skinny, some are tall, some are small. They all have a different body size because everyone is completely different. And when you look at someone's body size, you're able to tell about that person. You're able to tell, okay, if someone eats a lot and is really overweight, you're able to tell, hey, this person's eating way too much and they're not taking care of their body. If someone's really skinny, like myself, you could say, hey, this person's not eating enough or they need to work out more. And if someone is extremely brolic and muscular and looks like they have a lot of strength, you can say, hey, you know what? This person works out. They take care of their body. They're in shape. You're able to tell a lot about a person from their body size. And it's the same thing with the market. Each and every candlestick has a different body size. Some are big bodies, some are small bodies, and some have little to no bodies. Okay? And you're able to tell about where the market direction is going or what's psychologically happening behind each and every single candlestick. Okay? So let's just take a look at the candlesticks. Okay? So for instance, you can see this candlestick right here. Okay? Let's just zoom in on this puppy. This candlestick has a long wick up and a long wick down with a tiny body. Okay? So what can you tell about this candlestick? We can say, all right, you know what? Sellers are losing momentum within this candlestick. All right? The reason why is when you analyze a candlestick, you want to look at the psychological pattern of what had happened behind this candlestick. The psychological move, excuse me. You want to look at the psychological move of what happened behind this candlestick. So you can see price wicked up here. It opened at 1241.40. So it always shows the open, high, low, close when you put your mouse over the candlestick. It opened at 1241.40. Okay. It opened up here. And it went all the way up for a second. It went up to 1244. That was the highest it went. 1243.90. 1243.93. It was the highest it went. And then it went all the way down to 1236 or 1235. 1235. That's the lowest it went down. Okay? And then buyers pushed them back up. And the price ended up closing around 1240. So price ended up closing around here. What happened in this candlestick? Buyers wanted to buy and sellers wanted to sell. The candlestick started off here. Buyers pushed them up. Sellers got enough strength to push them back down. But buyers are like, no, we need to continue the trend. So buyers pushed them back up and price ended up closing here. Buyers want to buy and sellers want to sell. Okay, that's what makes Forex such an amazing market. It's a $4.5 trillion industry because there's always someone willing to buy and there's always someone willing to sell. It's on the spot, right there on the spot. So that's what makes Forex so awesome. And you could see in this candlestick, here's how everything played out. So who took control of this candlestick? Buyers took control of this candlestick because even though it closed bearish, price still got pushed up here and they closed here. It didn't close lower below this candlestick. It closed close to the top of it. Okay? Like right almost at the top. And then the price continued. All right? Now that's how you analyze a candlestick. Now let's go ahead and look at another candlestick. All right? So we could see here price wicked all the way up. Buyers shot all the way up. So price opened around 1265, around this area, 1265.32. It shot all the way up, okay, giving buyers a huge upside, and then price wicked down. Price wicked all the way down. It wicked down here, and then it ended up closing here, okay? Notice that this now closed lower. So this is closing towards the bottom. So this would be a sell. It's closing lower towards the end of the trend. All right. And after you see a fake out like this, all right, what you can use is this measurement tool just to be sure that the trend is going down and it doesn't continue up. This is a measure of, you can measure the pips on the candlesticks, okay? $1,709, okay? So 170 pips. You don't add the last decimal, you only add the 170. So you don't add the last number, you only add a 170. So 170 pips. Okay, 170 pips wicked back, okay? It wicked back. It ended up going all the way down here. So that should tell you that, hey, this is a fake out to the top. 170 pips couldn't break this level, so this will be a seller's trend, okay? So you see bodies like that. And you also see, you know, we have fairly large bodies. So this actually has no bearish sentiment, okay? And remember, guys, if we want to find out what words mean like bearish sentiment, we go, oops, Investopedia, okay? You go here. See, bearish. You can see what is bearish, okay? Or the word bearish. Bulls and bears, okay? So you can kind of get the definition of what all this stuff means. All right, now, as you can see, there was no bearish sentiment. And what I mean by that is you see no wicks at the top or no wicks at the bottom, really, that are showing you there's any sellers or buyers influence coming in. Some of these candlesticks show you when buyers or sellers influence is coming in. So see how this candlestick is fully bullish? There's no wick at the bottom. There's no wick at the top. So this closed full bulls. And price continued to rally. It consolidated for a minute, but it came up. Where this one, it shows you that there's some seller influence ahead because sellers tried to push down on this candlestick, but buyers ended up closing higher. So they ended up pushing price back down. They saw sellers come down here and then push price all the way back up. All right. So you can see that there is some seller sentiment here. And then what happens? The next candlestick, sellers come in, buyers push up one more time, and then sellers take control of the trend. So you can actually predict or have a great assumption of what will happen next in the market by looking at the wicks to see where sellers influence or buyers influence is coming in to make a change towards price. All right. So you see this is a really big body. Buyers are just getting stronger and stronger because there's no wicks going down. There's only wicks going up. Okay. So that is how you analyze a candlestick. Okay. Now, another thing that I wanted to go over is you will see on the daily chart, okay? So daily, hourly, 2 hour, 3 hour, 4 hour, 7 hour, 8 hours. I want to go over time, multiple time frame analysis, okay? Now, each and every single one of these candlesticks represent one day in the market. So this is 1 day, this is 2 days, this is 3 days, this is 4, this is 5, this is 6, this is 7, this is 8, this is 9, this is 10, 11, 12, 13, 14, 15. You get the picture, right? Then I could switch. I could switch to an hour, okay? And it will show me what the market is doing every hour. So 1, 2, 3, 4, 5, 6, 7, 8. This is what the market did for 8 hours. I could even switch to 5 minutes to see what the market is doing every 5 minutes, okay? Which is very quick, all right? So I don't personally recommend the 5-minute chart, but if it works for you, you can use it. And then you have the 1 minute, shows what the market is doing every 60 seconds, okay? So let's see how everything plays out. Like, let's look how this plays out. You know, it may start off seeming like it's really slow. And when it spikes you, that's when you're like, man, this is a very lucrative market. So 1 minute chart is really not my preference. Okay. Then you have, the 4 hour. 4 hour shows you what the market's doing every 4 hours. So you got 4 and 4, that's 8. Okay. 8 and 8, that's 16. All right. So shows you what the market did in a 16-hour period. I like to use longer time frames. The reason why I like to use longer time frames is because the longer time frames show me what the market is, or I can assume what the market is going to do in the next few days or the next few hours. Because on a longer time frame, you can get more of a clearer picture of what's happening, right? So let's just say we were to go to YouTube, okay? This is going to be a perfect example. Okay. If we see something happen here, okay, let me just when watching a game, okay, in slow motion, as you can see, when this happens in slow motion, you can see everything that's, if this were to happen within a second, you wouldn't be able to see it happen. You wouldn't be able to see the movement of this young man's hand hit Stephen Curry. You wouldn't be able to see the way it moved because it happened so fast. That's what it's like trading on the minute chart. You wouldn't be able to see the move because it happened so fast, just like that. See that? It's way too fast. See how it just spiked down? That's why you don't trade on the minute chart. All right? But on the, sorry about that. But on the 4 hour, you get a better perspective. Because then you can see, oh man, the slow motion of it happening. You can get more detail when you watch something in slow motion because everything is slowed down for you. Okay? That's why I like to use the 4 hour and the 1 day chart. I usually stay on the 1 day, 4 hour, and hour. Okay? Those are like my main time frames that I use. And of course I use other time frames. I have to upgrade my version of this. But I use other time frames like the 12 hour and 7 hour and 4 hour. Okay? So multiple time frame analysis is extremely important, especially on entering and exiting trades. Okay? So, for instance, let me give you an example. Okay. On this trade right here, okay, you see you got a little support line, which I'm going to go over support and resistance, but it breaks this line, okay? Price breaks this line here, and the next form of resistance is here, okay? This is way better on the daily because you get to see price play out. You give it time to play out and break the levels and go through your rules and do what the market does, okay? You give it time to move. And those who are patient are paid, okay? So patience pays. So that's why I like to trade on a higher time frame. Now, speaking of support and resistance, those of you guys that don't know what support and resistance is just basically your ceiling, okay, and your floor, okay? Your ceiling and your floor. Now, if you look up at your ceiling and your floor right now, you will notice that your floor is supporting you, right? Your floor supports your feet. And your ceiling supports your head, right? If it were raining right now, obviously your ceiling is protecting you because you have a roof over you, right? It's the same thing with trading, okay? Support and resistance levels work exactly the same. Now, you'll see price is supporting this level, okay? It's supporting key levels. It supported here, and it went up, right? It went up drastically, supporting this level. So when price hits a support level like here and goes up drastically, that lets you know, hey, this is a strong level of support. Okay? Price hit here and then went up drastically. Price broke past this zone and then went up drastically. Okay? Price hit this level and went up drastically. It hit here and went up drastically. It even hit here and went up drastically. So how are you able to find a support zone? Okay? How are you able to find a support zone, and how are you able to find a resistance zone? Okay? Support and resistance zone is everywhere. They're everywhere. Okay? You just have to find the right key levels when you're trading. Okay? How do you find the right key levels though, Dimitri? That's probably your next question. All right? You look at you look at zones like this. Okay? Where there's strong buying power or there's strong selling power, and it held and it's holding at these zones. So you see this resistance zone? See how this is a strong zone? It hit here and then it dropped. It hit here and then it dropped. Okay? Then price came and hit here. You'd be expecting for it to drop, but you're not going to take a sell, and then it broke. Okay? So you want to find strong resistance zone and strong support zones. This zone held strong for a minute, but as you can see, price hit here, and then when it swung, it missed this level. So it actually missed this level by 75 points. It missed this level by 75 points, and it pushed price down to this support level. Okay? On this support level, I would buy at the break of here. Okay? You buy at the break of here, and then price goes up to this level. Okay? You want to wait for price to close above this 1262 zone and then go up here. Okay? And that's how I would have taken that trade. And then I would have waited for this price to either break or push lower or close under. So if it was a sell, I'd wait for the sell to close under this and then take my trade back down. But it did end up breaking and going up higher. So that's how you utilize support and resistance zones for those of you guys who do not know. Okay? Now, our next step that we're going to go over is we are going to go over pips. Okay? How do you count these pips? Right? That's the hardest part. So, you don't really need to count them, but it's just good to know. You have the little measure stick right here where you can measure how many points that you're winning by. So 427 points. Remember, you're going to take out that last number. 427 points. Now, each of these works in tens. So 1263 to 1264 is 10 pips. 1264 to 1265 is another 10 pips. Okay? Now, 1263 to 1265 is 20 pips. Okay? 1266, that's 30 pips. 1267, that's 40 pips. 1268, that's 50 pips. 1269, that's 60. Then 70, then 80, then 90, and then 100. Okay? That's how they work. So you count them in tens. So a move from 1263 to 1264 is 10 pips. A move from 1263 to 1265 is 20 pips, and then so on and so forth. Okay? So now you guys know how to calculate pips. You guys know multiple time frame analysis, and you guys know the wicks and candlesticks that I use. And that is the end of our first educational video.